Okay, so what's the global equity setup and the Asian equity setup in particular looking like? Where do we fit in terms of the Indian market? Florian Neto, Head of Investments Asia at Amundi, is with us now for some perspective. Florian, so good to have you on the show. Welcome to the program. And it's good to connect again. So much has happened in the last 1 month. It's been absolutely crazy and chaotic. But now as the dust begins to settle and as Asian countries are busy negotiating with the US, when it comes to Asian equities, what's your call? What are you buying? What are you avoiding?
Well, thanks for having me this morning. Good to be on the show with you. It has been hectic in terms of news, and overnight again. Yesterday we got news on Nvidia. All the semiconductors in the region have been selling off. But we see a bit of resilience those days within Asia equities. Definitely, if we can take a step back and look into our preferences across, we did sell a bit of equity at the beginning of the month because the volatility was too elevated. But where our exposure is going today in terms of overweight is we try to find some shelter in domestic and defensive stories. So India is one. We are close to the max overweight we have been on India. It's our preferred country so far. We like China A, we like Philippines. So basically, we wait for the dust to settle before potentially reloading. At the end of the day, so at the end of the 3 months so-called 90 days pause, we will look very much into the relative tariff, because it will be a key feature as there are large export overlaps among Asian countries. So today, we are slightly lighter on equity compared to 1 month ago, and we have been changing a bit our allocation. We did start increasing India at the beginning of March, and we have been adding up to China A, fine-tuning, reducing a bit Korea and Taiwan of late, because they will be quite exposed from an export point of view so far. So this is how we are positioned from an Asia equity point of view.
Florian, great speaking with you. Prashant here. Could you give us a sense of what you're doing in India specifically? Between the common consensus view is large caps are more reasonably placed, mid caps, small caps are more still expensive. So just give us what Amundi is doing.
Yeah. From the consensus, we are not that far eventually. From a valuation point of view, I think one of the big headwind for India equities over the last 6 months was that foreign investors were perceiving India as being in a frothy valuation type of environment, and we got 2 quarters in a row of slightly weaker reporting. The last reporting season has been quite strong, actually, delivering 14% compared to Q4 24. And we've seen that financial, healthcare, communication has been delivering quite substantially. So the way so valuation, yes, are not cheap in our view, 20 times. So you have to pay 20 times for quality today. Very, very good profitability in general versus other peers in the region. So we're happy to step in on large cap. But for small and mid cap, as you mentioned, we do believe they are still a bit more expensive in our view. Then in terms of selectivity at the stock, at the sector level, our preference is going for banks. And you've been mentioning just before the interviews that banks have been skyrocketing. Indeed, banks have been outperforming. We are still committed to it. We like hospital. We like a food delivery platform as well. So we are selective in our allocation. We have another weight on India that is coming from bottom up actually preferences. But we do feel that it's a bit too early to step in on the small mid cap. At the end of the day, in terms of EPS, we are expecting earnings this year to be slightly lower than the consensus. The consensus is around 16-17%. We still have a solid double digit, but more around 11% today. So no big issues in terms of EPS, still good. Slightly lower than the consensus. We prefer large cap. We are still selective in terms of sector, and we do feel it's a bit early to go to small and mid cap.
I did mention that, Florian, that the Nifty Bank has been outperforming, and good to hear your thoughts. You're sounding reasonably optimistic on the Indian equity market prospects. My question to you is, what about the mother market? The US markets were the only game in town till a couple of months or so ago. Most of the flows were going out there. That market was doing well. Now the call is that maybe, in fact, the US markets have hit a near-term peak. Do you believe that's the case? And if that is the case, can the Indian market still outperform? Emerging markets like India, China, can be still outperform from here on?
Yeah, it's a good question. I think the big difference compared to when the US stocks was under pressure, and this is why history may not be actually very much of a help in this kind of environment, is that it's very unusual to see euro moving 2% up when the US equity is down 2%. So we do see that the dollar is now not behaving that like before as a safe haven, but the dollar and some US assets are behaving a bit more like emerging type of reaction function so far, because there is a question mark on the US administration, and there is a question mark as well on where the US is eventually going. So we do believe that US stocks will eventually do okay this year, but we don't think it will outperform the rest. So in this environment, it's still shaky for the US, but we do see earnings per share to be coming in. The big question mark here is where eventually are we going on the tariff side? As of today, we are in a pause for 3 months. If the reciprocal tariff are reinstated, our calculation from a credit spread point of view, from a dollar point of view, from a growth in the US point of view, leads to a close to recessionary level on the profit side. You don't need to have an economic recession to have almost no profit in the US. If it's the case, then it's a bit of a bear case scenario where eventually S&P will not move up significantly from here. We don't think it's a base case. We think that eventually the average tariff effective will be lower than what we've seen on the 2nd of April. And a lot of countries are now front runner. India is one, Japan is another one, front runner to have a bilateral deal. So in our view, US will perform okay, will rebound a bit from those levels. It doesn't mean that we cannot have a small leg down from there, but globally, when we look at our stock toward the end of the year, we do think that the S&P will be higher than what we are today. And we see that there is a bit of a decorrelation between what's happening in the US and what's eventually happening in emerging markets and in Asia more specifically.
Sure. All right. So, Florian, quick last question in that case. And that's an interesting call that you're eventually, once we get through this all, you're seeing the S&P 500 higher by the end of this year. Quick last call. When you chat with your peers, when other money managers around the world, your counterparts in US, in the run-up to Liberation Day, money was really moving to Europe in a big way. Money was still not coming to Asia. China had its own problems. India was being, called overvalued. We've seen a little bit of a change in the pattern of flows. We're suddenly getting more foreign flows. Do you see a bigger wave of liquidity coming to Asian emerging markets at all?
Yes, I think the big shifts that we've seen since the Liberation Day is on the rate side. So we do see that Asian rates now are a good alternative to US Treasury. And we've seen a lot of investors, being institutional, sovereign wealth fund, public pension fund, that are looking to alternative to the US Treasury. If the US Treasury is, and we see the steepening of the curve as fast as we've seen last week, for example, they want to find shelter. And the good news is the Asian rates have been actually having a very low beta to the US sell-off last week. Why? Because eventually the inflation issues that we have in the US, and we've seen Jerome Powell mentioning about this in your show just before, we don't have the same inflation issues in Asia. Headline inflation in India has been coming at 3.3, quite lower than the threshold of 4% from the RBI. And it's not an India story. It's the disinflation story is in Asia. So we like Asian rates, and we see that investors are turning a bit more constructive on Asia rates. When you hedge yourself, when you go on Korean curve, on Chinese curve, and you hedge the currency, you're actually having a higher carry than in the US. And we do believe that the central banks in the region have a I would say, are less in the corner than what the Fed is facing today with potentially stagflationary environment. Growth will be slightly lower. Inflation will be slightly lower in Asia. FX is still relatively resilient because the dollar is in a bit of a free flow. So at the end of the day, we do think that there will be more cuts in the region. Central banks will turn more accommodative, like RBI turned officially last week. And we expect more cuts, though Asian rates is where we do see a lot of flows coming in, on top of what you have been mentioning about European equities, for example.
All right. Thank you very much for joining us. It's a pleasure, and I hope this is the first of many interactions here on CNBC TV18. Good to get that take. Well, we'll take a quick commercial break here. We're going to come back in just a bit from now, top 10, with our research team coming up.